So all right, people in the class, welcome to this session, welcome to this class. And today I'm planning to also look at the RTP in the class itself, and I'm also planning to upload that video on YouTube. Shall we quickly have a look on the RTP, everyone, and then I'll take all your doubts and everything. Make sense? So who all are here in the slide batch? People in the class, come on, good morning. So I see Sahil is here, I see Durga is here, Omkar is here, great. Gargi, Dhananjay, everyone else, live and recorded people. Guys, very good morning. So Sahil, I've looked at your messages. We will talk about it, but just give me a second. I'm planning to first of all look at the latest RTP Institute has released. Cool. And then I will take care of everything else. Done? Randomly, I have not seen it. I'm just planning to see it along with you. Right, let us check if there are any new questions or not. And if there are we all able to have that thought process for those new questions? I have not seen it at all. Let me first of all figure out. So sorry for the delay, YouTube people. So I believe the screen is visible to you. This people are saying the ask the RTP for November 2024. Let us say what all does this RTP has, and people in the class, live people, recorded batch, everyone, then we will continue the session on Forex as we were on yesterday, right? Question number 1 talks about two friend A and N were discussing about risk of market, right? A is risk averse, N is risk aggressive. N said we cannot diversify the market risk elsewhere. He quoted the modern portfolio approach, right? Both friends analyzed the market data for the few months and came out with the expected returns for two particular markets. Are you people able to recollect the fact that this is the background story, but the question, people in the class, question remains the same as we have already done? Do you remember this question on portfolio management, which first asks you to find out the betas, and then it asks you to create a characteristic line maybe, or ask you to calculate the alphas, people, and also the equation of security market line? This question, as we have seen in the portfolio management, asking for the beta, easy. If the market return is equally likely, then the expected return using security characteristic line. People in the class, do you remember? Using security characteristic line, you have to tell this alpha of defensive stock is this. Come on, alpha. I mean, you remember we created two equation. What is the equation of characteristic line? That's a return on a security depends on return of market. So beta into return of market plus alpha, right? So that way we have two different returns of security aggressive and two different returns of market, where the beta we know is a common number, right? In fact, we know the beta. So do you realize we can back calculate the alpha through the equation of characteristic line? When this one is easy and we have done it, this one particularly seems to be a new part, right? The modern portfolio theory was propounded by, can you please tell me who was the person who came up with the modern portfolio theory? Who's considered the father of modern portfolio theory? In your outnotes, you have a picture of that guy. Come on. The first page of portfolio management, you have the picture of that guy in your outnotes. Where is that picture? Come on, everyone. The guy who comes to your dream after you've seen him. This person over here. I never knew that putting the picture of this person would be so impactful that you would be able to solve a question of RTP, everyone. I just put it randomly. I never knew that. See, when you look at the person and you relate, you remember his name, that is a better way to remember it, right? So that's really great, everyone. Harry Markowitz. Then, as per capital market line theory, the portfolio lying on the CML over the market portfolios, wow, what a beautiful thing, are called as borrowing portfolios over the market portfolio. So, which means we need to have quite a bit discussion on capital market line. Let me figure out when would we do it, either right away or later on. Cool. So this is particularly we will need to cover. Although in the capital market line institute does not cover, on the capital market line does not cover any practical question, but from theoretical perspective it is worth doing, which means at least we will become capable of solving. We will become capable of solving at least the questions like MCQ. So this is something we will discuss. Correct? Done. Just let us in the meantime confirm that when they say over market portfolio, so the equation of, one second, the equation of capital market line looks like this. In this equation, this rate particularly are RF and this is optimal portfolio, optimal risky portfolio. At this portfolio, the 100% weight is market and 0% risk free. Here 100% is risk free and 0% market. Where this is my risk and this is my return, the portfolio after, the portfolio over the market portfolio. This is the, everyone in the class, market portfolio. This one, this particular dot A is a market portfolio. So portfolio over the market portfolio are generally called as borrowing portfolio. Answer to question number 5th, let us confirm. I hope the institute has the same interpretation as I'm saying. This is something I teach to CFA students, but we have no worries. I'll teach it to you with all my clarities. Okay. So let us first of all part number 5. MCQ part number 5. Where are the answers? Question number MCQ first part number 5. First suggested part number 5, C is the answer. Diversified portfolio. So maybe another possibility, people in the class is about interpretation of the question. The question is the portfolio lying on this dot, on this market portfolio, the portfolio lying on this market portfolio, people, are similar to market portfolios, which means which are the most diversified anyways, because the market is most diversified. The interpretation I was able to have for this question, that the portfolio is lying over the market portfolio. So I thought the portfolios above the market portfolios. So these portfolio over here are called as lending portfolios. These portfolio over here are called as borrowing portfolio. The portfolio on the dot of market itself are obviously the most diversified portfolio. If that is the question, then obviously answer C is correct, where this particular portfolio is entirely a risk-free portfolio. 100% of the investment is in risk-free. Cool. So I think let us do one thing. People, are you in for this? If we take out a few minutes and try to understand the concept of capital market line, people, what do you say? People, what do you say? Because we anyways have the entire setup ready. In the outnote. Shall we proceed to do it? Come on. Capital market line. The setup is ready. People, what do you say? Everyone, please. Yes, no? Yep. So see. Generally in the portfolio management, people in the class, we have to realize that x-axis is generally the risk. X-axis is generally the risk and y-axis is generally the return. Because x is independent, as we have learned, security market line, security characteristic line, security market line, security characteristic line, you would know that x-axis we take independent variable, which is risk, and on the risk depends on your return, so y-axis is dependent, right? Now I have to tell you a particular thing. There is something called as efficient frontier. I would want to explain to you everything in a very limited manner. In fact, if you are able to recollect, did you remember I told to you this concept of efficient frontier? What did I teach you over here? Let me bring that chart. Let me bring that chart to that place. Let me bring that chart to this place and explain to you the concept of efficient frontier again. I said when I combine all the risky assets in the market, right? For example, in the market, there are hundreds of risky assets. Do you agree of those risky assets, I can make numerous number of portfolios for my own. I can select any 2 asset, any 3 asset, any 10 assets. Of those assets, I can keep any random weight, 10-90 or maybe 10-80-80 or maybe 70-20-10, any possibilities of any possibility of number of security in my portfolio and their weights in my portfolio. Come on. So of those huge number of portfolios, right, do you agree every portfolio that I create will have a portfolio return and portfolio risk? Everyone in the class. Portfolio return, do you remember the weighted average return of individual security? Which one? Portfolio return, people in the class, do you remember this? Right away. Portfolio risk, do you first of all remember this? Portfolio risk and portfolio return as well, do you people in the class remember this? The weighted average. So as we know, every portfolio has its risk and return. So based on which, people in the class, I can plot. I can obviously plot every portfolio on this line. Come here. So for example, if I pick up all the risky portfolios, every portfolio will have some risk, some return. So some particular portfolio has this risk, this return, the point gets plotted here. Another portfolio has this risk and this return, the point gets plotted here. Similarly, one portfolio has this risk and this return, the point gets plotted here. So similarly, for different portfolio, when I plot them for different risk and return, they look like this. So for this portfolio, first of all, say that the portfolio is made up of only risky securities. There is no risk-free securities. So of all the risky securities, how much is the minimum level of risk I can achieve, people? Now when you're learning capital market line, you should know more terminologies. What is the minimum level of risk I can achieve? This much. Can you see on the risk line, on the line of risk? There is no point lesser than this. There is no point over here. All I have is this particular point. So portfolio falling on this point, having the least risk, everyone, is called as minimum variance portfolio. And do you agree, we have already solved a question of minimum variance portfolio, which is as you can see here. Okay, so we discussed it at this point. We didn't create a graph, right? But we have a concept of minimum variance portfolio. Do you people remember, in fact, the formula? In fact, the formula, this horrible formula, do you remember we learned it? Come on, live people, give me a response. Yes, no, quick, everyone in the class, please. Sahil, Gargi, Omkar, Dhananjay, all the live and recorded people in the class. The record doesn't seem to be here, right? So sir, first thing, this is a minimum variance portfolio. Second thing, sir, among all these portfolios that you see, which portfolio would you choose? Which portfolio would you choose, right? So sir, if I am capable of taking this much risk, suppose this is 10% standard deviation. When I say risk, I mean to say standard deviation. Suppose at this 10% standard deviation, right? How much at this level of standard deviation, if I'm capable of taking this much of risk, which portfolio would you invest in? Portfolio A or portfolio B? Come on, everyone, give me your answer. Which portfolio would you invest in, portfolio A or B? So we said, sir, we will invest in B because for the same level of risk, B offer to me a higher rate of return. Portfolio B is a more efficient portfolio than portfolio A. Similarly, for example, if my risk taking appetite is, for example, 14%, everyone in the class, then would you invest in portfolio C or would you invest in portfolio D or would you invest in portfolio E? Come on, everyone in the class. Sir, portfolio E, because for this level of risk, I have portfolio E to be the most efficient one because it gives me a higher rate of return for the same level of risk as compared to portfolio D and E. This way, do you realize for different level of risk, I have one efficient portfolio on the top for each level of risk. And all these efficient portfolio, the line made of this efficient portfolio is called, as people in the class, efficient frontier. Efficient, the word frontier is boundary. So of this area which represents all these security, this particular boundary tells us that all the portfolio lying on this particular boundary are called as efficient portfolios, and the line is called as efficient frontier. I just need a quick validation of how settled are you on this point. People in the class, right away. How settled are you? Come on. Tell me. Quick, right away. Come on, the capital market line has not even started yet. Are you guys not able to process it? Should I make you people do again the things? Settled, Omkar. Others in the class, what do you say? Now the point is, settled. Now the point is, sir, each of these points on this line represents a portfolio. This is a portfolio, this is a portfolio, this is a portfolio, fine. Similarly, can you tell me if there is a risk-free portfolio, if there is a risk-free portfolio, where should it be plotted? Sir, risk-free portfolio has zero risk. So on this axis, it will be at 0 point. But it has a return, which means on this axis, it will be plotted at this point. So for example, my risk-free rate of return is 8% or say 6%, and this is the dot of 6%. So we will say this particular portfolio is a risk-free portfolio, right? This particular portfolio is a risk-free portfolio where the rate of return this portfolio generate is called as RF. The rate of return this portfolio generate is RF. Sir, now I have to create, listen to me now very carefully. Now I have to create a line which passes. Now I have to create a line which passes from the risk-free rate and the line, people in the class, which is tangent to efficient frontier. Do you remember the word tangent, people in the class? The word tangent, that sir, if there is a circle, if there is a line which passes through the circumference of that circle, I don't want to sound like a math teacher, but I hope you people remember. Come on, everyone in the class, tell me, do you remember what a tangent is? So if I draw a line which passes through the edge, through the boundary of this efficient frontier, right, we call this particular line. So we have to draw a line from risk-free security to the point which is the point of tangency to the efficient frontier, right? Capital market theory says that this line, this particular line, the point where it touches the efficient frontier, which means this particular point, the point where it touches the efficient frontier, this particular point, everyone in the class, is called as market portfolio. Market portfolio. In fact, if you allow me, hold on for a second. Let me make the discussion of market portfolio. Hold on. I want to make it look better for you. Cool. Now this looks good. Which means the point where it is touching. Come on. This particular point where this straight red line, everyone is touching to the efficient frontier, that particular portfolio is called as portfolio, market portfolio. Now you have to understand what this red line is telling. Now I am explaining a bit more than that question. Why? Because when that question can ask you about this portfolio, that question may also ask you at some point in future about this and this portfolio, right? What's wrong? One second, guys, one second. So people in the class, what we were trying to understand is that on this efficient frontier, people, this portfolio is a minimum variance portfolio, and this particular portfolio where this red line crosses, the or touches the efficient frontier is called as market portfolio. Now you have to please imagine, do you remember all the portfolios in the efficient frontier were all risky portfolio? There was no risk-free asset. Yes, sir. Which means, sir, this particular portfolio, market portfolio, if I imagine the weight of risky asset and the weight of risk-free asset in this portfolio, can I say the weight of risk-free asset in this portfolio, market portfolio M, is 0 and the weight of risky asset is 100%. At this point, all I have is the market securities, which means securities in the index, which is all the risky securities, no risk-free securities, right? This particular portfolio has a risk, which means, can I say the risk of this particular portfolio should be risk of the market, which is a standard deviation of the market, and risk of, come on, return of this particular portfolio, return of this particular portfolio, which is market portfolio, everyone in the class, will be return from market. So return from market portfolio is RM, return from risk-free portfolio is RF. Common sense, relatable. Risk of a market portfolio is a standard deviation of market, and risk of a risk-free portfolio is zero. Needless to mention, right? This is all clear, all set. And sir, this market portfolio has 100% investment in risky security and 0% investment in risk-free security. Similarly, if you imagine the risk-free portfolio, risk-free portfolio, people in the class, do you agree, has 100% investment in risk-free security and 0% investment in risky securities, which is why we call the portfolio to be risk-free, because even if have some percentage of risky security, then the risk will not be zero, risk will be more than zero, if you realize. So this point represent the risk-free portfolio having 100% risk-free and 0% risky. This point also represents a portfolio called as market portfolio, which has 0% risk-free and 100% risky, right? So can I say this particular line, people in the class, represents different portfolios? In fact, this entire chart is about the portfolios, right? Where this will be the return of portfolio, this is the risk of the portfolio. So sir, this line represents the portfolio. Sir, at this point, on an average, I'm saying intuitively, can you feel at this point there would be some portfolio in which 50% will be risky and 50% will be risk free? Are you understanding? Here you invest 100% in risk free, here 100% in risky. Then can I say at this point over here there would be some portfolio in which 50% will be risky and 50% will be risk free? People in the class, are you able to please connect to me? Everyone, everyone, I need a validation on this, because once you say yes to this, in the next 5 minutes my entire discussion gets over. Come on, come on, right away, people in the class. Similarly, there would be some portfolio here, for example, in which 75% of the securities, for example, intuitively would be risk-free and 25% risky. Or maybe over here, only 25% risk-free and 75% risk-free, risky. So this line represents the portfolios. But sir, till this point, it is all understood. For example, intuitively, let me find out the center. For example, is this. So I say 50% in risky and 50% in risk-free, which is fine. But sir, what about this? What about beyond this point? Sir, the weight of risky is 0. As I go ahead, the weight of risky become 50 and the weight of risky further become 100. Sir, what about if I go beyond it? Sir, beyond it, let me tell you, the weight of risky become 125%. But how can the weight of a security be more than 100? It is possible only when the weight of another security is negative, everyone. That is how the total become 100. Do you people remember this? Portfolio management, when the weight of one security is more than 100, which means another security has a negative weight. And now I bring to you the discussion which all of you have learned really well. Can someone please tell me that over here I have a positive? If the weight are positive, then the position is long, and the weight is negative, then the position is short. How many of you, everyone in the class, remember this discussion? Long position, positive weight; short position, negative weight. Positive weight in the risk-free security, which means I have invested in those securities. When you invest in risk-free security, now it will be fun for me to teach you or maybe help make you recollect something. When you take a long position, do you remember this discussion? Long position in risk-free securities, which means you are lending to someone, and short position to risk-free security, which means you are borrowing from someone. And now you would be able to relate to the discussion or the question that examiner asked, that sir, why is it? One second. Yeah, you would be able to now relate to the discussion that, sir, in this area, let me mark it with green. Let me, people in the class, mark it with green. On this, from this point to this point, from this point to this point, since I have positive weight, since I have positive weight in risk-free security, since I have positive weight of risk-free securities, I would call the portfolios to be, people in the class, hold on. Let me first of all shift the minimum variance portfolio here, and let me say these portfolios, everyone in the class, is called as lending portfolio. Why? Because I have a positive weight on risk-free security. Agreed? Similarly, after this point, I start to have a negative weight in the risk-free securities, and such portfolio, people in the class, are called as borrowing portfolio. Borrowing portfolio. And that is why? Why? Because they have negative weight in risk-free securities. Which means, are you people now realizing the main question examiner wanted to ask? Sir, first and the most important thing, that this line, this red line, everyone in the class, is called as capital market line. This red line, people in the class, is called as capital market line. So they say that the question says that on this capital market line, the portfolio over the market portfolio, the portfolio over the market portfolio is a lending portfolio or a borrowing portfolio or a diversified portfolio. So the interpretation which I initially made, was by over, I thought over and above, which means going towards the top. So this particular portfolio is borrowing. But now, based on the answer, I feel the interpretation of the question is over, which means on the point itself. On the point of market portfolio, if there is any portfolio lying on the capital market line that has 0% weight in risk-free security, neither it is borrowing nor it is lending, it has entire investment in the market, and market is the most diversified portfolio, as you have learnt. Which is why people in the class, answer to this particular thing is diversified portfolio. But now with this discussion, you have learned what is lending as well as what is a borrowing portfolio. So sir, this is my risk-free portfolio, option D. Beautifully it has framed the answer. It is not a random thing. This is risk-free, this is lending, this is market, this is borrowing. Are you people all clear with all possibilities of answer examiner can ask to you, everyone? And do you really appreciate the theory and the chart as people in the class? Beautiful. And it is your existing knowledge of long position, short position, lending, borrowing portfolio, which made me easy, which made my life easy to explain the entire thing to you. Live people, recorded people, YouTube people, come on, everyone in the class, could you connect? What do you say? And now you realize how bad I feel, right? I know the institute never asked a practical question on this. Randomly in the MCQ it asked this question, and imagine I made my plans to explain all these things in detail to you in the outnotes. But now when I see that the institute is not focusing on this, even I and you, we don't focus on it. Right? We keep the discussion limited by, avoiding such things. Anyways, now we got lucky to learn this out. Done? So, I'm planning to... So anyways, this is done, right? This is done. Great. Fine. So this was all, people in the class, about capital market line. We are now moving to the next discussion. So this gets over, this gets over. Come on. Oh my God, this is a second question. The second question, people in the class, is so one thing. Do I have the permission to go back and make you people realize one thing? Sir, this blue line represents the line of portfolios which has only the risky assets. Blue line represents the list of, or represents the portfolios which has only risky asset. However, the red line represents the portfolio, which is a combination of risky asset as well as a risk-free asset. Which is why for this red line, the minimum risk is even zero. The minimum risk is even zero. But for a efficient frontier, the minimum risk is this minimum variance portfolio. It is not zero because all the securities are risky. Could I convey to you? Right? Done. Great. So in conclusion, I can make you people write down one more thing. What thing? Sir, efficient frontier. Let me write down one thing. Represents portfolio of all risky securities. Capital market line represents portfolio of risky and risk-free security. Because now when you have learnt everything, why do I miss any particular thing which may become a part of the... Now when we know everything, why do we miss anything which become a part of the MCQ? Right? You want me to, Omkar, make you write down the note for the last two sentences. You mean the note related to lending and borrowing portfolio, is it, Omkar? Come on, quick, please. I think, Omkar, you won't be needed because since you have a positive weight of risk-free security, you would be able to relate this with the previous topic, that table which I shown to you. That positive weight is long position, is lending portfolio, right? Negative weight is short position, is borrowing portfolio. And I will upload this video on YouTube anyway, so you will be able to recollect it whenever needed. And in the worst case, can you please consider capital market line? I have just written it down. The capital market line represents the portfolio of risky and the risk-free security. Yeah, I wrote that only. Done. Great. So question number 7 is the question from mutual fund. Do you remember that question we did on the timeline? That for the first 7 years, this is the return. For the next 1 year, 7 month, 2 years, 7 month, this was the return. So we were given the annualized return, right? This question simply we have done is all easy, manageable, right? Question number 3 from derivatives. Let us read what do they want to say. Mr. H is holding 100 share quoted at 2100, interested in hedging, right? A 2-month call option is available, 2-month put option is available. The strike price is 2200. You are required to, wow, what a question. Everyone, yes, everyone in the class, second question you can recollect we have done. The third one, can you people listen to it? Everyone please look at this. What's wrong with the screen? Something is wrong, everyone. Why this? Yeah, come on. So you are holding 100 shares. Listen to the question very carefully. You are holding 100 shares, right? And this is not the exact question we have done, but you in the class are going to tell me the answer. We have done a similar question of Ram. Ram holding shares of Reliance, I remember, 1000 rupee price. Anyways, sir, H is holding 100 equity share of V, quoted at a price of 2100. He is interested in hedging because he is going to sell them after 2 months. Come on, the question of hedging reminds me of a golden rule. People, do in derivatives today what you will do in the spot market on a later date, right? In the derivatives market, you should do today what you will do on a later date in the spot market. In the spot market, you will sell it after 2 months. In the spot market, you will sell it after 2 months. What should you do today? Sell it today in the derivatives market. Okay, fine. A 2-month call option is available at a premium of 60 and 2-month put option is available at a premium of 50. The strike price is 2200 in both the case. You have an option to buy the underlying asset and an option to sell the underlying asset at a price of 2200. If you buy a call option, you have to pay rupee 60 as premium. If you buy put option, you have to pay rupee 50 as premium. Suggest the position Mr. H should take in the option market to hedge, it's holding. Everyone, if you want to hedge, come on, suggest the position along with the correct security call and put. People, what position would you suggest and in which security call and put? Think, do in derivatives today what you will do in the spot on a later date. On a later date, after 2 months, if I sell, I should make that arrangement in the derivatives market today only to sell. You guys tell me which of the two options give me an option to sell the underlying security. It is the call. Is it the call or the put? People. So obviously, sir, it is the put option which gives me an option to sell the underlying asset today only. People in the class, which is the hedging arrangement. That's really great. So in my opinion, they should suggest a long position input. If I need to have the option, come on, live people interact. If I need to have the option, I will have to take a long position on put. So hopefully for the third question, that is the answer. I hope they have not suggested short call. He should buy equal number of put option. Buy is long position, put option as we have discussed, right? So third question, the suggestion gets done. After that is the payoff calculation. Come on. Final position is gross payoff calculation. All easy, done for you. Sir, Sneha has a portfolio about in which she is concerned about the rebalancing. Similar question we have done on the portfolio management, not a new question. EVA calculation where this concept of bad debt was being applied, everyone, is there in the latest RTP. You remember this question had ambiguities. Let us right away confirm if the ambiguities has been resolved or not. Yeah, in our book it was Indira question, that's true. Indira question. Below the question of Sunidhi, two rebalancing question we had. So this is question on CPPI. Now, fifth question, do you remember had ambiguity? The institute add back 30 rupees to the EBIT, to the current assets in the debtor, I mean to say, but fails to consider it while calculating WACC. Should we check if the institute has rectified the solution? Come on, everyone in the class, right away, let's check for question number 5, the solution. Question number 5 says my EBIT is this, tax is this, non-cash expense, unfortunately they are adding after the tax, which is fine, right? Similarly, to my assets 30 rupee get added, so the capital investment is 1380. And do you people realize in the while calculating WACC, they should in the denominator consider the correct weights of 1380 and not 1350. So the problem continue to remain, the ambiguity continue to exist, which is fine, all right. Anyways, we have we have learned the ambiguity only, na, we don't mind. Done. So fifth question, all easy, all set. Sixth question, the forex we are yet to do, but you will realize that this question is already there in the notes. In the forex, and had we have continued the session, we could have done this question today only, or we might be able to do it today only. I don't know, I'll have to check, right? Sixth question, easy there in the forex. Seventh question, obviously there in the forex. Eighth question, advanced capital budgeting, is there in the capital budgeting in our book. The question is there. Okay, all easy, all done. Come on, the question of derivatives. How many of you remember this question? Simple, that derivative bank question, overnight index swap. On a daily compounded, we used to calculate the floating part. Come on. On a daily compounding, we used to calculate the floating part. Ninth question, all easy. Question number 10th. Let me tell you, we have already done it. Question number 10 in the chapter of money market. Fixed income security money market instrument. The question number 10th is already there in the OutScanner, right? So in this video, people in the class, I'm so sorry, especially for YouTube people, I missed to specify that this particular question is where in the OutScanner, sorry. But as I said, you would be able to very easily find all these questions, right? In the chapter of fixed income security, in the section of money market instrument, if you look at the last 2-3 questions on repo, you will find this one. Similarly, last 7-8 question of derivatives and interest rate risk management, you will find this one, right? All these questions you would be able to easily find in respective chapters. Cool. Oh my god, this one from derivatives, do you remember? Where we learned this entire setup of security lending borrowing scheme. Come on. There was this blue guy who was that long-term borrower lender. Then there was this red guy in the middle who was short seller. This blue guy, everyone, come on. And this then green guy, the normal buyer and seller. Do you remember the chart, people? Now he used to sell the security, buy it back, etc. Was based this entire question on. And you still remember I said that question has a mistake that both the scenario it says bullish, to which we changed one as bearish. The problem continue to exist. Okay. Mergers acquisition. Mergers acquisition, easy question. We have already done it. I literally remember doing this question in the power batch yesterday, right? Where growth before the acquisition is 6 and growth after the acquisition is 8. So examiner is trying to give to you the hint, everyone in the class. The examiner is trying to give to you the hint. It is all there in the OutScanner, not a new question. The objective of this video is to discuss only the new question, right? The examiner gives you hint that if I acquire the target, the value of target will increase, because right now the value is right now 50 of the target based on 6% growth. After the 8% growth, with the help of applying Gordon's model, I can find out the revised value, which will include the value of synergy in it. Which means I have to decide, come on everyone in the class, those who are able to recollect, please recollect. Sir, I had two possibilities in M&A. The post-merger MPS and related calculation I could do. Come on, come on, come on. Let me show you everyone in the class and the outnotes. I cannot now control myself. M&A. Come on, where is that M&A thing? Do you remember we had two possibilities? Sir, which two possibilities? These two possibilities. The post-merger MPS and related calculation, everyone, you can go either by way of earnings or by way of value. If the examiner gives you the detail of post-merger market value or the synergy in value, etc. things, we can go directly by way of value. If not, we have to go by way of earnings, which is pattern to PE. That was how we went, right? Now in this question, if you realize, have we been given the synergy in value? Yeah. Rather than 6, if the company grows, if the target grows by 8, the value of the target will be more. And this is a hint of synergy in value. We will apply this particular logic, which is my value plus your value plus synergy in value, not my earnings plus your earnings into P ratio. The value way, which is what this question number 12 is about. All easy, sorted. Question number 30 is a new question, kind of, not a new question. Similar question is there in the OutScanner, okay, to be done in the chapter of Forex. And then you have theory questions, right? One particular reminder, everyone. I remember in the theory questions, right, the definition of unicorn is missed to be taken from the chapter of startup finance. Let me tell you clearly one particular thing. In your outnotes, there is this chapter of startup finance, a theory chapter, in which there is this particular concept of unicorn. Except for this particular definition, because the definition is not big enough to have a content for a 4-mark question, but they asked it unfortunately. So except for the meaning of unicorn, you have everything all covered for the chapter. So this particular thing, everyone, just remember that you will have to cover it from the study material, otherwise we are all set. This thing I was supposed to explain to you when we come to the theory section at the end of all these lectures, but now when I see it, I thought of reminding you right away itself. Done. So all right, people in the class, that completes the entire discussion on the RTP of November 24, and it got covered for those who are attending these lectures, and automatically on the YouTube will be there this video. The only problem is for YouTube people, I was supposed to take it Yeah, Omkar, I'll do it, don't worry. So only problem is for YouTube people are supposed to take it in English language, लेकिन अभी इंग्लिश में ना लेकर एक इंग्लिश बैच चल रही थी तो फिर सब कुछ इंग्लिश में ही एक्सप्लेन कर दिया, राइट? So all right people, great. Bye YouTube people, we are going back to our